Have you ever found yourself wondering how a conflict that's happening thousands of miles away can actually hit your mortgage payments right here in the UK? It's a question a lot of us are asking, and that's exactly what we're going to break down in the next few minutes.
I mean, it seems totally disconnected, right? A conflict between the US and Iran is all over the news, and then suddenly your own financial future feels, well, a bit shaky. But believe it or not, this isn't just a feeling, it's very real. There's a direct economic line that connects that geopolitical tension to the interest rate on your home. So let's trace that line together.
So, here's the plan. We're going to trace the global domino effect. Take a look at what the experts are saying, figure out what strategy you can choose, and then wrap it all up with the bottom line.
Okay, first up, let's follow that chain reaction. It all kicks off with something economists call a geopolitical shock.
So think of it like this. A conflict breaks out in a big oil-producing region, and that spooks the energy markets. So boom, oil and gas prices spike. Then, because energy costs more, inflation starts to rise across the board. Now, here's the really crucial bit. Financial markets see this inflation coming, and they react by driving up something called swap rates. And since lenders use those rates to set their fixed-rate mortgages, the final domino falls. Your mortgage rate goes up.
Let's just zoom in on swap rates for a second, because this is the key to the whole puzzle. These are not the Bank of England's base rate. A better way to think of them is as the financial market's best guess, their prediction of where interest rates are headed in the future. So in fear of long-term inflation hits, these swap rates can shoot up almost overnight, even if the Bank of England hasn't done a thing.
And here's what that actually looks like in the real world. I mean, check this out. The data from MoneyFacts shows that right after the recent conflict kicked off, the average 2-year fixed rate jumped by a full percentage point. It went from 4.84% all the way up to 5.84%. For homeowners, that is a huge and immediate jump in borrowing costs.
And it wasn't just the rates that got hit. The market itself just shrank. Lenders got nervous with all the uncertainty, so they pulled a staggering 21% of all mortgage products right off the table. To put that in perspective, that is the biggest shock to the market since the 2022 mini-budget. It's a really clear sign of just how fast lenders react to this kind of global instability.
So that's what happened. The million-dollar question now is, what happens next? Are these rates going to keep climbing, or are we going to see them start to come back down?
Well, to be totally honest, the experts are divided on this. On one hand, you've got some analysts who think that if things calm down and inflation cools off, we could see the Bank of England start cutting rates later in 2026. But there's another, more cautious view that this ongoing global risk means we should all just get ready for rates to stay higher for longer. Basically, the risk of war has slammed the brakes on any hopes of quick rate cuts.
And hey, you don't just have to take their word for it. This is a direct warning from the Bank of England itself. They've said in no uncertain terms that the economic outlook has deteriorated and that mortgage rates could rise even further. That is a pretty sobering message coming straight from the top.
Okay, so with all this uncertainty swirling around, what on earth are you supposed to do? Let's get practical and talk about strategies for your own mortgage.
You know, when you strip it all away, it really boils down to one big decision. Are you playing for flexibility or are you playing for stability? It's the wait-and-see approach, where you're betting things will be better in 2 years, versus the peace of mind strategy, where you just want to lock in a payment you can count on no matter what. Let's break that down. A 2-year fix is for the optimist, someone who thinks rates will fall. The big pro is you get to remortgage much sooner and hopefully grab a better deal. The con? Well, you're rolling the dice again in just 24 months. On the other hand, the 5-year fix is for anyone who just wants to sleep at night. It protects you from any more shocks and makes budgeting predictable. The only downside is, if rates do fall, you're stuck paying a higher rate unless you want to pay a pretty hefty exit fee.
Now, here is one single, really actionable tip. If your current mortgage deal is ending anytime in the next 6 months, pretty much every expert agrees, you should be looking now and locking in a new rate early. It's really the best defense you have against any more surprise hikes.
Okay, let's pull all this together. What is the bottom line for your financial planning?
So here's what you really need to remember. First, what happens in the world directly affects your wallet. Second, the future is uncertain, so it's probably smart to expect rates to stay up for a while. A 2-year fix gives you flexibility, but it's a gamble. A 5-year fix gives you stability and certainty. And ultimately, there's no single right answer here. The best choice depends completely on your own budget and how much risk you're comfortable with.
And that really leaves us all with one final question to think about. In a world full of economic shocks and uncertainty, this choice isn't just about interest rates anymore. It's about what you're willing to pay for stability. So, in today's market, what price do you put on peace of mind?